Hi everyone, welcome to our webinar covering Ginnie Mae issuer readiness. Before we dive into today's topic, I'm going to run you through some items to help you best leverage our platform. Your webinar dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of the icon to adjust the size or position. You have many tools running across the top ribbon of your dashboard. If you can't find something, look there first. We encourage you to engage with us using the interactive tools. If you have any questions throughout, please submit them in the question box on the lower left corner of your dashboard or push the Ask Question button on your top ribbon. We will do our best to address your questions in real time. You will also notice a survey on your dashboard. Should be highlighted right now. Please fill this out at any time during the presentation. To let us know your thoughts throughout the presentation, use the emojis at the bottom of your screen. Your feedback is truly valuable to us, and we use it to craft future webinars. For those of you seeking CPE credit, you will need to answer 3 out of 4 poll questions during this webinar. CPE certificates will be sent out via email within a couple of weeks. Lastly, this session is being recorded. You will receive a link to the recording within a couple of days. If you want a copy of the slides, you can download it from the right side of your screen at any time. You will also find links to other resources there. For those of you who aren't familiar with Ginnie Mae, we have specialized in serving the mortgage industry for over 40 years. We have a full suite of services and products designed to enable our clients' growth. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching. Today, our presenters include 2 of our mortgage industry experts. I'll turn it over to Josh Jensen to kick off our introductions.
Yeah, hey everyone, just want to welcome everyone to our Ginnie Mae webinar today. My name is Josh Jensen. I serve as a mortgage partner here within the mortgage audit department. I've been with the firm for I think 14, maybe 15 business seasons. Pleasure having you all here today, breaking away from the World Cup match where I think Ronaldo finally found his right foot again. We'll be covering a lot about kind of getting ready for Ginnie Mae if you aren't already Ginnie Mae approved, kind of what that process looks like, and then kind of taking it across the finish line, and then once you have that approval, what the requirements look like. So with that, I'll turn it over to Jacob.
Thanks, Josh. I'm Jacob Mumm. I'm a senior associate here at Ginnie Mae. I've been with the firm for about 5 years, and this will be my 5th year on the Ginnie Mae team. I've been leading the testing and review side of the Ginnie Mae team for the last 3 years. So yeah, definitely excited to present this presentation on Ginnie Mae and teach you all a little bit more about what we do. So in today's meeting, we're going to go over the Ginnie Mae process, including a general introduction to Ginnie Mae, the Ginnie Mae approval process and requirements, how this approval can aid in growth and revenue strategies, and then how to comply with Ginnie Mae requirements and maintain your Ginnie Mae approval. After the presentation, we are going to have an open Q&A, so please think of and add in questions as they come to you, and we will do our best to answer them for you. So to kick off this presentation, I'm first going to give some background on Ginnie Mae, including a brief overview of what it is and some of the key players involved in the process. But before we get into the slides, we are going to have our first poll question to help us get an understanding of where you're all at on your Ginnie Mae journey as we go through the rest of our presentation. As a reminder, if you are looking for CPE credit, this is one of the poll questions you will need to answer today. You'll have to answer at least 3 of the 4, so this is a good one to get started on. The question here is, what statement most accurately reflects your current knowledge of Ginnie Mae and the overall issuer process? A, no knowledge, you're new to Ginnie Mae. B, you're familiar, but no specifics. C, you have a decent understanding, but there's room for improvement. Or D, you know everything, but you just need a refresher. So polls should be open to you guys. Go ahead and answer. All right, looks like we still have a few more people who need to answer. I'm going to give you guys about 10 more seconds, and then we're going to move over to the results. So whoever hasn't submitted, go ahead and submit. All right, we're going to move over to the results now. So it looks like we got a good mix of responses here. Looks like most of you are in the camp of familiar but don't know specifics or have a decent understanding, but there's room for improvement, with a few of you with either no knowledge or with a lot of knowledge but just needing a refresher. So I think we're safe to kind of go over the background then in a little bit extra detail, just for those of you who are a little bit less familiar. So with that said, we're going to get into the slides here. So first slides here, what is Ginnie Mae? So for a brief overview of Ginnie Mae is the Government National Mortgage Association. It's a government-owned corporation that operates within the U.S. Department of Housing and Urban Development, i.e. HUD. Unlike some of the other housing agencies, Ginnie Mae does not originate loans, buy loans, or issue mortgage-backed securities itself. Instead, its primary role is to provide a guarantee on mortgage-backed securities that are backed by federally insured or guaranteed home loans, such as FHA, VA, USDA, and certain HUD loans. This guarantee gives investors confidence that they will receive their payments on time, even with missed mortgage payments, including principal and interest. Because the guarantee is backed by the U.S. government, Ginnie Mae securities are generally considered a very low credit risk security. Now let's talk about the Ginnie Mae issuer. The Ginnie Mae issuer is a financial institution who has applied with and been approved by Ginnie Mae and that has met Ginnie Mae's eligibility requirements. These issuers are responsible for pooling eligible mortgage loans into mortgage-backed securities and issuing those securities into the market. In addition to issuing the securities, the issuer also services the underlying loans, meaning they collect monthly mortgage payments from borrowers and manage the accounts. The issuer also serves as the administrator of the mortgage pool, ensuring that payments are passed through to investors and all Ginnie Mae program requirements are being followed. So in summary, Ginnie Mae provides the government guarantee that aids in investor confidence, while the issuer is responsible for creating, servicing, and administering the pooled mortgage-backed security. So now that we've discussed Ginnie Mae and the role of the issuer, let's look at another key player in the process, the document custodian. The document custodian is an independent entity responsible for safeguarding the original loan documents that support and collateralize the Ginnie Mae issued mortgage-backed security. Think of the custodian as the houser of the loan file. Their role is important because investors rely on the loan file as collateral for the security. The custodian maintains and protects important original documents, including the collateral file documents like the promissory note, deed of trust, mortgage-related legal documents and assignments, and title insurance policies. The custodian also houses and protects the pool-specific documents, which establish the eligibility of the pool and support the issuance of the pooled security. This role is critical as the value and enforceability of a mortgage-backed security depends on the integrity of those documents. If there are missing documents, incomplete documents, or improperly executed documents, it creates a legal and financial risk for the issuer and the investor. Because of this, Ginnie Mae has established a strict requirement for how loan documents must be reviewed, stored, tracked, and certified. The custodian reviews these documents prior to the official issuance of the security to ensure the security is in compliance with Ginnie Mae requirements, at which point the custodian certifies the loan pool, providing assurance that the correct collateral is present and stored. In many ways, the document custodian serves as an independent quality control checkpoint within the securitization process. Custodian oversight helps protect investors, supports confidence in Ginnie Mae, and ensures legal compliance. So while the issuer creates and services the mortgage-backed security, the document custodian helps ensure the underlying collateral is complete, accurate, and securely maintained throughout the life of the security. So with all of that background out of the way, I'm now going to turn things over to Josh for an overview of Ginnie Mae approval and growth strategy, including what Ginnie Mae can do for you and your company.
I appreciate it, Jacob. So when we talk about Ginnie Mae approval and growth strategy, really want to focus on, what Ginnie Mae can do for you, what it can do for your entity, kind of as you evaluate becoming that seller and servicer of Ginnie Mae and the securities. But before we get into that, just want to do a quick poll question. So again, poll question number 2, you do have to answer 3 out of 4 to get that CPE credit. So poll question number 2 is, where are you in your Ginnie Mae approval process? So A, my company is already approved. B, my company is in the application process. C, my company is considering applying. Or D, my company is not ready to apply. I'll give everyone about 30 seconds to respond. Looks like we have a good bit of submittals, so I'll go ahead and move on. All right. So as expected, about half of you have already been approved. I think as of last week, there was just north of about 300, maybe 330 single-family Ginnie Mae issuers out there. About 8% are in the application process, so that's good to hear. My company is considering applying, about 23%, so about a quarter of you, and then 17% of you are not ready to apply. So about 40% are in that swath that either haven't started the application process and are still kind of contemplating it. So that's good. So I think for 50% of you, the next several slides will be more of the refresher of kind of that painstaking process of getting over the hump, and this will be more of a reminder if you were the ones that were filling out all the paperwork, I would assume. So kind of talking about, the key approval pillars, what it takes to become a Ginnie Mae issuer. At a minimum, an applicant must be an approved FHA mortgagee in good standing. Typically what we see at Ginnie Mae is, most of these IMBs are already approved sellers and servicers with Fannie and Freddie. And Ginnie typically is that last ticket that they're looking to get. You've already demonstrated experience in underwriting, origination, and servicing, and you've maintained a qualified management and infrastructure to issue and service mortgage-backed securities. Again, when we talk about financial requirements, there's a couple of minimum thresholds that kind of, what we see mostly is a single-family programs. We see a handful on the reverse side as well. But when we speak about the single-family programs, there's a net worth requirement of $2.5 million, plus an additional basis point requirement that's tied to a servicing portfolio. So when you think about your FHA loans and so on and so forth, that requirement can increase. You also want to be mindful of unacceptable assets, and that varies when. For that 40% of you that are thinking about it or aren't yet at that approval process, when you think about the unacceptable assets for your HUD net worth requirement, a lot of those still apply for Ginnie Mae, but there is some nuance to it. So just be mindful of what those are as you go through the approval process. Liquidity also, liquid assets typically require at 20% of your base net worth is also a requirement. There's also a capital requirement above or equal to 6% equity to total assets. And then there's additional requirements that went into effect a few years back that are a risk-based capital metric, as well as servicing-related net worth add-ons. So quite a bit more that Ginnie Mae kind of scrutinizes the lenders than just your typical HUD requirements. When we talk about operational and governance requirements, what applicants must demonstrate is quality control programs that are specific to origination, servicing, and secondary marketing. There's certain fidelity bond coverage and mortgage E&O insurance coverages that are just absolutes, as well as servicing oversight capabilities. So even if you're utilizing a sub-servicer, you need to have internal oversight with at least 3 years of experience. So that's also, that's an area where a lot of IMBs fall short that we see is Ginnie Mae really expects an issuer level accountability even when a subservicer is involved. And then when we talk about infrastructure readiness, internal evaluation needs to be performed in terms of an organization's ability to provide accurate, timely reporting, managing pool level data, and as well as maintaining operational systems that support the Ginnie Mae requirement. So just a few pillars there to get through. When we talk about the financial requirements, touched on this on the previous slide, but I'll just reiterate again. When we talk about that minimum net worth, just keeping in mind that $2.5 million is just the baseline. We know, when we think about HUD net worth, it's kind of starts at that 1 million, can kind of flex up, whereas Ginnie's that 2.5. Liquidity obviously is equally as important. When we talk about servicing, cash is king. So really it just takes cash to service, obviously. And then when we talk about, the stress testing and forecasting, issuers really have to demonstrate the ability to maintain compliance under stress conditions, which includes elevated delinquency rates. That's obviously been a point of focus here over the last 18 to 24 months for a lot of folks, just with delinquency rates being really high, increased servicing advances, and then obviously market disruptions, just with everything that's been going on in Iran, so on and so forth. It can be Ginnie Mae can obviously cause a lot of headaches. But there's obviously a lot of reward that can be had on the MSR valuation side of the house too. And then when we talk about the financial readiness, it's not simply about meeting the minimum thresholds, but it's really about demonstrating kind of your resilience, kind of the scalability and sustainability in an environment where liquidity and capital discipline are essential to that long-term success. Kind of moving on to the next slide. When we talk about the readiness evaluation and next steps, what you really need to assess, kind of have an assessment framework in mind. Looking at the financial strength of the entity is oftentimes where Ginnie Mae is assigning the greatest weight, as it reflects the organization's ability to meet the net worth requirements, liquidity, capital requirements, while obviously sustaining the operations under stress, as I previously had mentioned. The operational capability evaluates the effectiveness of the servicing platforms, your staffing, oversight processes, as well as ensuring that the organization can manage loan portfolios efficiently. When we talk about compliance maturity, this assesses more or less like the robustness of your QC programs, whether or not you have an internal audit program, if that's in-house, maybe it's outsourced to a third party. Governance structures, which are critical for meeting ongoing program requirements. Infrastructure readiness, that focuses on reporting systems, data management, and technological capabilities, which are necessary to support Ginnie Mae operations. And finally, the strategic alignment, which examines whether or not the issuer status supports the organization's broader business objectives, which includes growth and profitability goals. So really what that application looks like, each one of these categories is scored on a standardized scale that allows the organization to kind of identify its strengths and weaknesses objectively. The resulting score provides more or less like a clear recommendation as to whether or not the entity is ready to apply and can kind of really zero in on the weaknesses that it might have and where it can essentially improve upon that application before it submits. When we kind of look at the application process, it's essentially a form HUD. I think it's 11701, I believe, is the form that's required to be filled out. Basic documentation is I think it's like 3 years of audited financial statements, org charts, personnel resumes, background checks, your insurance certifications, QC program documentation. Ginnie essentially performs that review. They look at financial data, operational review. There's oftentimes some back and forth with everything's, the process can go, for those that have gone through it, that 50% that is, that's already, gotten their ticket. They probably, can share some war stories of maybe how long it can take. And then that, 8% that is currently going through it, there can be some back and forth with Ginnie Mae that can often take months if that package isn't complete, or if there's questions about, any certifications or any missing documentation. Just remembering that approval is discretionary and meeting those minimum requirements doesn't guarantee acceptance. Which, albeit is unfortunate, but it kind of is what it is. Kind of continuing with the implementation roadmap, when we talk about the post-approval, you still are required to meet those ongoing net worth and liquidity requirements. And if anything, they're probably going to grow as you plan to, the ultimate goal is to probably grow that servicing portfolio. So net worth requirements are likely going to grow as that portfolio is going to grow. Similarly with liquidity, that likely will increase in time. You're going to have, a separate Ginnie Mae reporting that you have to do. As Jacob mentioned previously, the document custodian review is going to be something that you have a requirement to do. Ginnie Mae compliance is another item that your third-party auditor has to complete. So in addition to the loan file testing that hopefully Ginnie Mae is doing, but if not, that other auditor's performing as part of your financial statement audit. There's, the Ginnie Mae testing is pretty rigorous as well. And then obviously you're complying with with the MBS guide as well. So practical path, building that foundation is obtaining FHA approval. Oftentimes we see again that FHA or the Fannie and Freddie servicing tickets kind of come first and second, and building that servicing platform kind of scale and getting comfortable with a good subservicer before applying for that Ginnie Mae ticket is oftentimes what we see, and more or less kind of ensuring that capital structure supports the Ginnie Mae stress scenarios. And we talk about the readiness phase, implementing a solid Ginnie Mae compliant QC and reporting, stand up liquidity monitoring and scheduling, and then preparing for an AEP and custodian oversight, I think are key as well. So really setting up the structure well ahead of the application process, so you're not kind of scrambling on the back end, I think is really key. And then applying and surviving the diligence, I think is I would probably say for those that are going through the process, expecting kind of heavy scrutiny on the liquidity stress capacity test. Servicing advances, if you're having issues even with like your Fannie and Freddie servicing advances, probably expect some scrutiny on those from Ginnie. And then just the management experience, you're probably going to have a lot of questions in terms of what kind of experience do they have in the servicing realm. I think the better your team is and the better you surround yourself with just quality servicing people, just the easier that process is going to be. All in. Moving on into our third question. This one has stumped, I think, even a few folks internally. So again, this will be a third one. So if you get past this one, you'll be awarded that valuable CPE certificate. An approved Ginnie Mae issuer services loans included in Ginnie Mae MBS, mortgage-backed securities. A borrower becomes 90 days delinquent, and the issuer is evaluating its options. Which of the following best describes the issuer's obligations under the Ginnie Mae program? Your first choice is the issuer may stop advancing principal and interest once a loan becomes 90 days delinquent. Second choice is the issuer must continue advancing P&I to investors regardless of borrower delinquency, but may repurchase the loan out of the Ginnie Mae pool once it becomes sufficiently delinquent. Option C is the issuer is not required to advance P&I because Ginnie Mae guarantees all payments directly to investors. D, the issuer must immediately modify the loan within the Ginnie Mae pool once the borrower becomes delinquent. And while those questions are coming in, I'll actually answer a question that came into the Q&A, and please continue to submit these. The question is, how many new issuers have they approved in 2025 and year-to-date 2026? That's a good question. I could certainly ask Ginnie Mae that. We went through and kind of scrubbed the Ginnie Mae because all this information's online. We went through and scrubbed it. I mean, we've seen obviously a lot in the M&A where people are surrendering their tickets, or there's been some tickets that have been acquired by acquisition. So if anything, it seems like I'd say that's almost been like a net zero year over year. I don't know, Jacob, if you've seen that. I just went through it, like I said, last week, and we had probably, when Jacob gets back on, I'll do the exact number of single family, because I want to say it's around 320 or 330, and I want to say like we did the same practice maybe last fall, and it was around the same number. So like I said, I think they're around net zero. So I think for everyone that falls off, whether it's a ticket being taken away, which again, you don't hear about that too often, but usually it's just surrendered because the company is being acquired, and they just surrender that ticket because they just determines they don't want to go through the process of trying to sell it or anything of that nature. Yeah, so good question. We could probably get back to you to see if there's an exact number on that. But again, I think as I was filling that out, I was probably like in terms of like typing out new entities, like new banks, new lenders. I would say it's less than 10 that I was like, hey, here's 10 new lenders. So we have a good amount that have answered, so I'll move on to the next slide. And everyone, yeah, 89% get it right. Great job, everyone. So yeah, kind of following under that, you have more than trivial benefit to buy that loan out, and 90% or after that 90-day period of delinquency. But the issuer still has an obligation to continue to advance the P&I on that loan. And then under GAAP guidance, the lender should be recognizing that loan on their balance sheet as a asset and a corresponding liability. But good job, everyone. All right, so now we're going to get into kind of how Ginnie Mae approval can help you. So kind of speaking to that 40% that are, either, hey, we're not thinking about it right now, or maybe we're kicking the tires on it. And then even the 8% that are like, yeah, we're going for it. So strategic value of Ginnie Mae and the issuer status. We feel like, and I think a lot of the lenders probably can speak to it as well, as the strategic value of becoming a Ginnie Mae issuer more or less extends well beyond kind of the regulatory participation, and directly impacts kind of the long-term growth strategy, revenue optimization, servicing strategy of the entity. But really kind of the most significant advantage is just the ability to access securitization and executing on those government loans. Allowing issuers to package and sell loans into the Ginnie Mae mortgage-backed securities rather than relying solely on whole loan sales is kind of the name of the game. It provides enhanced pricing efficiencies. It can improve margins, particularly in volatile market conditions where execution spreads can really be critical and can kind of make the difference on whether or not you come out ahead in a down year or in the red. Also kind of thinking about, retaining servicing rights. I think, again, if people are looking to grow those portfolios, I think if we look at 2025, 2026, a lot of entities, as you read, if they break even, a lot of them are breaking even because they're running slim margins, but the ones that are really, positive, they have big books of servicing portfolio, that they just have that income that cash flow is just coming in on a monthly basis, or they're able to dip into that servicing portfolio and get cash by way of bulk sales. So, issuer status enables lenders to retain servicing rights more consistently, building that income stream through servicing fees, creating valuable balance sheet assets in the form of mortgage servicing rights, being able to create more value, not only today, but, in the future. Another key consideration is just having control over operational workflows, the control and efficiencies. I think as issuers gain greater influence over the pooling, servicing, and reporting aspects, this can create kind of a downstream effect for borrower outcomes and operational efficiencies. But I think one thing you really need to take a look at as you're kind of weighing the pros and cons of is just the increased compliance requirements. So definitely talk to those lenders that have gone through the process and talk about the cons. Just the increased compliance requirements, capital demands. Certainly there is some added operational complexity to being Ginnie Mae approved. And then just, the decision to pursue issuer status should, really be grounded in a clear strategic vision. It shouldn't be done just, hey, we're just going to do this just to do it. It really needs to be, you need to have a why behind it. And it needs to align with organizational long-term objectives, including like growth targets, capital allocation strategies, and just having, built into essentially kind of a risk tolerance. Looking into, kind of securitization capabilities. I think we talk about kind of the immediate liquidity, converting loans into immediate liquidity oftentimes is the core driver behind becoming a Ginnie Mae issuer. So again, being able to securitize Ginnie Mae allows lenders to sell pooled loans into the capital markets rather than hold them on the balance sheet. This frees up capital to originate more loans. So really, in practice, the originator funds a loan, securitizes it into Ginnie Mae MBS, and then they receive the execution proceeds, and then they essentially deploy the capital, and that cycle just kind of continues. So that's really that core driver of the why for the issuers, and accessing, again, kind of gaining access to deeper and cheaper capital is also kind of a core driver behind getting that issuer ticket via the government guarantees. So Ginnie Mae, MBS, they carry that explicit full faith from the U.S. government guarantee. This makes them highly attractive not only to the investors, but it also broadens the buyer base. It creates higher demand, which results in tighter execution spreads versus a wholesale loan. And we talk about enabling FHA, VA, USDA production at scale. So it just gives you just that much more production capacity, rather than just your typical conventional loan. So just adds that much more value, I think, to an overall entity. Also, just with that ticket, it gives you full control over your execution strategy, being able to retain versus release, and the ability to compete in government lending markets. I think is it's a key component of just being a Ginnie Mae issuer. We talk about, the creation and retention of the MSRs, major economic value there. So securitization separates the servicing from the loan. As the MSR generates the ongoing servicing fee, and we find it's typically anywhere between 25 to 44 basis points on average. You get float income, ancillary income. MSRs are primarily that long-term asset that's on the balance sheet for many IMBs, and it's typically the probably the highest valued asset on the balance sheet for many IMBs. And oftentimes it's kind of at least in down years, the last several years, it's been kind of the difference maker in terms of whether or not entities are net positive or negative at the end of the year. So talk about margin enhancement, kind of versus co-issue or servicing release. Relative to selling loan service release, I think retaining service loans leads to higher lifetime economics if it's properly managed, of course. And then you have kind of the optionality. So you can sell the MSR later, you can leverage it, or you can hedge it. So you do have a lot of options just with being able to service that loan. Next, we'll talk about just the enhanced flexibility. So kind of the other side of that. So being able to kind of stop the cash drain from P&I advances is also a key component of having that ticket. So while servicers must continue passing through principal and interest to investors, even when the borrower stops paying, this obviously can create significant liquidity strain. But having that Ginnie Mae ticket gives you the option to buy the loan out, which then allows you to stop that advance requirement, frees up liquidity, and reduces financing costs. Oftentimes we've seen those Ginnie Mae pool buyouts. Oftentimes kind of repooling the loans, packaging them up, and then selling them back off to another buyer can often be pretty advantageous way just to kind of free up some servicing advances and get those loans back off your books. Managing delinquency metrics, kind of talking about the Ginnie Mae compliance. I think Ginnie Mae monitors delinquency thresholds. So kind of speaking about those buyouts again, removing delinquency buyout loans from the pool, it really helps lenders stay in good standing with Ginnie Mae. Enabling loss mitigation. Ginnie Mae has pool rules that limit modifications while a loan is in the security. Once you buy it out, lenders can modify the loan, put the borrower on repayment plans, modify it, so on and so forth. Just gives you, the issuer, greater flexibility to cure the loan and manage credit risk. And then creating upside via re-performance. So again, if the borrower cures the loan, the lender can re-securitize that loan back into a Ginnie Mae pool, often at a premium, is what we've seen. So sometimes you can get a little bit of an uptick once you've re-pooled that loan. And there's a potential economic upside. That's not just risk mitigation. And then finally, strategic portfolio and capital management. So this buyouts allow lenders to essentially kind of shift loans out of securitized form and into whole loan portfolios, allowing you to sell or transfer to specialty servicers. There's plenty of those out there, allowing you to optimize your MSR performance and capital usage. And then, a lot of times what we see is why EBOs or early buyouts is considered kind of a core servicing strategy, at least in today's kind of market. And it's not just a compliance process. So with that, I will turn it back over to Jacob, and he'll talk a little bit about the compliance side of the house, doc custodian, and once you're approved, so for that 50%, 8% that are either already issuers or in the process, what you have to think about on a day-to-day basis.
Thanks, Josh. A lot of good, helpful information there. So yeah, for this last section of the webinar, like Josh said, we're going to discuss my personal bread and butter, Ginnie Mae compliance, so that you guys can all know how to remain Ginnie Mae compliant once you have that issuer approval. Before we get into the slide, we have our last CPE polling question. So this will help us gauge your pre-existing knowledge of Ginnie Mae compliance. And again, as a reminder, if you want CPE for this webinar, you need to make sure you answer at least 3 out of the 4. So this will be your last opportunity here to get that that third question answered for CPE. And another reminder, you don't necessarily have to get the question right. You just have to get an answer in there. So for this last question, who is required to receive Ginnie Mae AUP audit? Is it A, Ginnie Mae issuers with over 1,000 loans? B, Ginnie Mae issuers with over 1 million in UPB of Ginnie Mae loans? C, all Ginnie Mae issuers? Or D, Ginnie Mae issuers approved in multiple states? Let's go ahead and get those answers in. All right, looks like we got a good amount of people, but a few left. So I'm going to give you about 10 more seconds to get those answers in, and then we'll move to the results. All right, move over to the results here. So nice, looks like most of you got this one right, about 88% of you. So the answer is C, all Ginnie Mae issuers. So regardless of whether or not you have any pools or Ginnie Mae loans, if you have that issuer approval and you want to maintain it, you do need to get a Ginnie Mae AUP done. So yeah, nice job, everyone. So this slide here is going to reiterate some of the things that Josh mentioned. As we just established with the poll question, Ginnie Mae issuers, regardless of loan, pool count, UPB, state approval, they're all going to be required to get that Ginnie Mae AUP to remain compliant. The AUP is an agreed upon procedures audit, meaning there's no opining on an audit opinion. It's actually just an objective set of procedures performed that are treated as a pass or fail based on the testing. So these procedures we summarize for you guys in a Ginnie Mae AUP report, where the exceptions are detailed and there is an opportunity for like management responses as well for some specific cases. But yeah, we'll outline the exception, what happened, all that good stuff. The AUP is performed on site at the document custodian. So that's a requirement from Ginnie Mae that we do the AUP on site. And it's based on a rolling annual cutoff. For most of our clients, we use a 6/30 cutoff. There are some exceptions to that. And then as Josh also previously mentioned, in addition to the Ginnie Mae AUP, and this is similar for your HUD approval, Ginnie Mae has its own liquid asset minimum net worth requirements, which are required to be met and are included in the audit report at year end. These all have their own unique calculations. A lot of them are largely based on the UPB of the Ginnie Mae portfolio, and then there are some other factors as well. So they're a little bit unique compared to the HUD calculations. There's some similarities, but some differences as well. And if anyone has any questions or wants to see a copy of the calc, just reach out to Josh or myself. We're happy to send you over the template for you to review. For the Ginnie Mae AUP review, custodians can elect the single audit approach, multiple auditor approach, or both. So the single audit approach is just one auditor. They aggregate the results of the AUP based on sampling performed across all entities that opt into the report. The multiple auditor approach allows clients to choose an auditor to perform the procedures isolated to the individual issuers. There are 4 current document custodians, US Bank, Truist, Deutsche Bank, and Wilmington Trust. US Bank utilizes the single audit approach. Truist has the option of either the single or multiple, depending on the issuer preference. and Truist and Wilmington both allow the multiple auditor approach, as well as Deutsche Bank. There are pros and cons to each approach. The multiple audit approach is typically going to be a little cheaper for the issuer, and it results in less selections and less overall testing for the individual issuers. However, exceptions are aggregated, meaning if an issuer has like a clean file, they're still going to have an exception on their report if a different issuer was sampled and there was an exception identified. The single audit approach alternatively allows for a more catered and isolated testing on the specific issuer, giving more accurate results to the specific issuer and identifying issues more accurately on that issuer level. Ginnie Mae allows issuers to utilize multiple custodians. Just something to keep in mind here, if an issuer has multiple custodians, you are required to alternate where the AUP takes place at least once every 3 years to ensure full coverage. So for example, if you have US Bank and Deutsche Bank as your two custodians, you'll just need to make sure that every 3 years you have at least 1 year where you're getting Deutsche Bank and then 1 year where you're getting US Bank. But you can do still like 2 years in a row at Deutsche, then do your third year at US Bank or vice versa. So let's look at the specific areas the AUP performs procedures on at the custodian. For purposes of the Ginnie Mae AUP engagement, us as auditors perform procedures in 4 primary areas of the document custodian operations. First, we look at the eligibility of the custodian. So we'll verify that the document custodian continues to meet Ginnie Mae eligibility requirements. Procedures here focus on confirming that the custodian maintains an active custodial agreement, possesses adequate controls over document custody operations done through inventory reconciliations and inventory release reports and notifications, and complies with Ginnie Mae program requirements. For example, here, having an annual audit, required net worth, insurance, and minimum capital requirements at that document custodian level as well. This area also evaluates whether the custodian has appropriate segregations of duties in place, physical security measures like fire protection rating, and record keeping practices to safeguard collateral documents and master issuer files. A representation letter is also sent to the custodian to ensure all of the document requirements are being met. The next area here is the pool file. The auditor selects a sample of pools and examines pool level documents maintained by the custodian to determine whether required Ginnie Mae documents are present, complete, and properly executed. The review includes documents such as the HUD 11711A, custodian certification, HUD 11711B document exceptions, and other issuance-related records supporting the creation and certification of the Ginnie Mae pools. This verifies that the pool and files are securely maintained in accordance with Ginnie Mae requirements and accurately supported by the document custodian. Next thing we look at is the collateral file. So we'll select a sample of loans and inspect the underlying collateral file to determine whether required documents are present and being maintained. Testing typically includes taking a look at the original signed promissory note, the mortgage, also known sometimes as the deed of trust, assignments, title insurance documentation, and other required loan documents. The purpose here is to confirm that the collateral supporting the Ginnie Mae security is complete, legal, and properly housed at the custodian. The final area we look at is the release of documents. A release occurs when a loan pays in full, meaning the mortgage obligation is satisfied. At this point, the custodian and issuer sign an 11708 authorizing the release of the collateral file to close out the loan. So here we'll request a sample of loans that have paid in full, and we'll verify that the releases were properly and timely authorized, documented, and tracked in alignment with Ginnie Mae requirements. And Matthew, I see you had a question here on the AUP. Is the AUP every year or every other year? So you are required to have an annual AUP done if you have that Ginnie Mae approval. So it'll be an every year requirement. Again, the only nuance there is if you have multiple custodians, you'll just need to make sure one's done at least once every 3 years. And you don't need to do both of them in the same year. So you'll just, again, like I said, if it's US Bank and Deutsche Bank, 1 year you can do Deutsche, 1 year you can do US Bank. But yeah, good question.
Yeah, and just to add to that, Jacob, in terms of the multiple custodians, just to clarify, you just want to make sure that, say you had two, right? You're just making sure you have coverage within a 3-year cycle. So if you had U.S. Bank and Deutsche, you're doing U.S. Bank for 2 of those years and Deutsche for 1 of those years, or vice versa. At least getting the coverage on both of them in a 3-year cycle.
All right. So that brings us to the end here of our presentation. Again, we appreciate everyone for your time and attention. And at this point, we're going to have that open Q&A for any questions that you guys might have for Josh or myself. So go ahead, get those questions into the box. And if we don't get through all the questions, we'll definitely follow up with you all individually. But yeah, if you have any questions, throw them in. Start getting those answers out.
And Jacob, it looks like we do have a few questions. First one was, what is the average time frame for the overall process from the time the application is submitted? It's a great question. I would say it's really hard to say. I've heard it's taking as long as a year, but I would say like first time issuers experiencing like anywhere between 6 months to a year. But a lot of it relies on just readiness, how complete your application is, how timely you are with, if Jenny's coming back asking for question or asking for, hey, can you provide this? Can you provide that? It is, how complete is that application? How solid is your application? I would say most approvals would probably take 3 to 6 months in a perfect world, but 6 to 12 is probably more realistic if it's a first time issuer. So yeah, so I think to answer your question is probably it varies, but probably no less than 3 months, and hopefully no more than 12. Looks like another question we have, Jacob, I'll let you tackle this one. Concerning the doc custodians, when we've gone in, or just in general, like when we reviewed maybe like a U.S. Bank, like the single audit, when they do the single audit approach, what are some of the most frequent findings or exceptions that we've seen in recent years?
Yeah, it's a good question. So the findings can definitely vary, but there are a few that we definitely commonly see. For the active testing, so that's the testing over like the pool and collateral file. I'd say the most common one we see is that late or missing final certification. So once you get a pool certified, so that initial certification, you have a 12-month requirement to get the pool final certified. And a lot of times we'll see those that either they just haven't gotten the final certification yet and it's been 12 months, or it's, over 12 months has elapsed between the initial and final certification. So that's definitely one to keep an eye on. Also, if you're like looking at the 11708, so this is for those like paid in full loans, a lot of times we'll see those also like late released. So we have this rolling 630 cutoff. So if any of those are released after the cutoff, but they paid in full prior to the year end, that's going to be an exception as well. So, once those pay off, it's a pretty quick turnaround for needing to get those release documents signed. So I'd say those are probably the two that we see the most often.
Great. And we have another question. How involved is the individual issuer in the AOP review process?
Yeah, I can take this one too, Josh. So another good question there. So the issuer is responsible so we'll get an engagement letter sent out to you, and you guys are responsible for getting that engagement letter signed. We'll also request those listings directly from the issuer. So that's another thing that you'll have to do, is getting us those active and paid in full listings over to us in the correct period that we're requesting. After that, there's not a ton of involvement until we get to like the finalization process. All of the testing is done at the document custodian, and it's all like a point in time for the most part. So, we do all of our testing on site, and then we start working on our end on getting those draft reports out to you guys. Once we get those draft reports out to you, at that point, you will have to review the draft reports, and we'll also provide a management representation letter. So similar to the audits where you'll have to sign that and, approve the draft. And it's a similar thing where, we're not going to release the report until you guys have approved those drafts. So we need to have those rep letters at the same time that we get that draft approval so we can finalize timely. But yeah, at that point, that's pretty much all you'll have to do. So it's a little less hands-on, I would say, for you guys from a client perspective as a typical audit. Again, a lot of the work is done through the custodian, but there's still a few checkpoints.
We have one other question, I think. Jacob, I can tackle this one. I think the question is just how many buyers are there in the PIT program? I don't know that there is a published list of that. I mean, we're aware of, a lot of the big players out there that we would all come to know. We try to avoid stating any entity names on our webinars that are CPE focused, but I'm not aware of like any published list that's out there. So I hope that. Sorry that I don't have an answer to that. And for anyone that doesn't know what PIT, it stands for Pools Issued for Immediate Transfer. So it's just a Ginnie Mae program currently. I think we're nearly at time.
Yeah, it looks like we got one more question.
We do have one more, yeah. It looks like, what is the timeline of the AUP process from engagement letter to finalized report?
I can take this one too, Josh.
Sure, go for it.
And another good question there. So we typically send out engagement letters in early June. So that's kind of like the beginning of the process there. Once those all get signed and sent to us, at that point, we'll send over the request for listings. We typically do this in July with the rolling cutoff of 6:30, like I had mentioned earlier. Again, there are some one-off exceptions where that rolling cutoff might be a little later. And in those cases, we'll send those requests out timely. The timing of the AUP audit itself depends on the custodian you use, and it kind of varies a little bit by year. Typically, we like to do the travel for Deutsche Bank in September. That's where most of our clients are. So that's a little bit of a bigger trip. So we usually do a week out in California for that audit in September. And then for Truist or Wilmington, if you have one of them as your custodian, we usually go on site for them in mid-October, and we usually do the same week for those two just because of the number of issuers. We don't have any involvement with US Bank. They have a different single auditor. I'm trying to remember if it's PwC or EY. Do you remember?
I believe it, it was EY last year. I think it's
EY.
I think they've changed auditors a few times, and then I know Truist has had a single audit performed in the past. And then we found it, obviously, so for those on the call or that are listening that maybe haven't had Ginnie Mae handle this in the past, we've spoken to those with that 6:30 cutoff, and some audit committees would rather have it a little later in the year, which is totally acceptable. And like Jacob said, we've made some exceptions, and I know Deutsche has allowed us to come out a little bit later in the year for some of those one-offs. We haven't had to do that with Truist or Wilmington previously, but if that's 6:30 is not acceptable, with an audit committee, we could certainly have that discussion. But in terms of testing purposes, as long as it's an annual requirement, the guidance doesn't state that it needs to be a 1231 practice. It's an annual requirement. So for testing purposes, as long as it's done once a year, it meets that requirement.
Yeah. Yeah. And then the only other real timeline thing is like the finalization process. So, that again varies a little bit depending on custodian. It's usually about a month or two out from the testing. So for the Deutsche Bank clients, typically we'll send those rep letters out and those draft reports around October, November at the latest. And then for Wilmington Truist, it's usually November, December at the latest. Some are as early as month of, but yeah, most of them are a month or two out in terms of the drafting and finalizing. And then just another comment on US Bank quick, if anyone has them or are looking at them as their document custodian, those reports you do have to opt into. So you'll just need to make sure you opt into the testing of that one to be included as one of the issuers getting a report. And you'll need to make sure you do that prior to their cutoff. So you'll want to reach out to your rep over at US Bank for that. But yeah, I think that is all our questions, unless I'm missing any.
No, I think that's it. Just want to thank everyone for joining us for this last hour. I think we're 1 minute over, but really appreciate the time. Here's our contact information. So if you have any follow-up questions or are interested in learning more about Ginnie Mae, not only just the AUP for the doc custodian, but if you guys are interested in learning a little bit more about just the readiness and what that looks like, our advisory team can certainly sit down with you and talk through that. That is a service that they have performed for some entities in the past as well. So we can certainly pass you off to them and they can talk to you about what that might look like. But with that, we'll let you get back to your day and really appreciate your time.